Thanks, Kim, for having me again. How's everybody doing? You know, Fitzgerald got a bigger response than that. I don't have like a Palantir that I can throw out there, but so I'll try it again. How we doing? Much better. All right. So I'm going to spend 20 minutes with you, maybe a few less, answering the question, why should you invest in real estate if you're not already doing it, and why now? But in order to do it, we have to go back. So there's going to be no exam at the end of this, but I'm going to teach you a little bit of history. Quick question, who's that up on the screen? I heard like a it's like Charlie Brown's parents out there. There's two correct answers. That's either Moses or Charlton Heston. Either are acceptable responses. But if we go all the way back, literally, to biblical times, throughout history, there's only two ways in which wealth has been accumulated on the planet. This is fact and this is history. The first way is precious metals. So literally, if we went back to biblical times, and archaeologists have found it, they've found coins dating back before the Common Era. There has been a way to accumulate wealth in precious metals through the dawn of time. However, that precious metals basket has evolved, and I'll talk more about that in a second. The other way that wealth has been accumulated on the planet is through real estate. These two pictures, by the way, thanks to our friends at Google, when you Google biblical land, those are the two images you get. But if we go to modern times and you Google image real estate today, that's what you get, okay? But here's the case for investing in real estate, okay? In times of uncertainty, two things happen, okay? So this is uncertainty. Who here would argue against the notion that right now we're in uncertain times? I don't think anybody is going to argue that we're not in uncertain times. However you define uncertainty, okay, you're probably going to sort of scratch an itch and say, yes, we're in perilous or uncertain times. So two things happen in times of uncertainty. I mentioned the precious metals basket of wealth accumulation, okay? Within the precious metals basket, investors tend to rotate to the safest bets in that basket. So the precious metals basket today includes stocks and bonds, okay? The stuff that Keith and Ralph were talking about, things with CUSIP numbers, maybe insurance policies, crypto, gold. All of those things are in the precious metals basket. And when you see a market sell-off on a day, it's not uncommon to see stocks sell off, golds go up, and bond prices go up as well, okay? Why? Because when people feel uncertainty, they tend to fly to the safest bet. That's just human nature. However, there's another truth, that in times of uncertainty, people tend to, and again, this is proven throughout history, and I'll give you a case study in a second, people tend to rotate out of the more volatile precious metals basket or the trading asset basket, and they tend to rotate into real estate, okay? And I'm going to give you a case study, okay? Before the change in sovereignty, if you will, of Hong Kong, what did the Hong Kong Chinese do? Many of them either moved physically to Vancouver or they bought real estate in Vancouver. They bought real estate in other places in Canada. They bought real estate in the United States. Why? They were worried about the safety and security of their invested assets, their trading asset basket, their precious metals basket, and they wanted the safety and security of real estate, okay? We can find that pattern throughout time, but I often use the Hong Kong 1999 example. So that's what happens. So what do we have today? We have enthusiasm towards real estate investing. What happened during COVID? During COVID, people had accumulated wealth because they couldn't spend it. They accumulated wealth in their trading asset basket. And what did they do? They bought more houses, okay? They bought a vacation house that they had dreamed of buying. They bought cars because they could. These are things that tend to happen, and we see it in real estate. So this is a survey that was done, and it says America's opinion of real estate being the best long-term investment and this is back in 2023. Another sort of example of the case for real estate, I will throw this in the caption of not just investor sentiment, but this is about underlying fundamentals, which is rent growth. So apartment rent growth has outpaced home price appreciation over time, okay? That tells you that if you're an investor in real estate, rental real estate, the fundamentals are strong and remain strong for investing. But there's an overarching issue, and Ralph made reference to stock prices being a function of supply and demand. Real estate as an asset class is a function, and its price in the market is a function of supply and demand. Who here in this house, in this audience, has bought a home once in their life? Okay, should be virtually, well, it should be 63.4% because that's the home ownership rate in America. But in any event, if we look at the housing market, we see a dramatic undersupply of homes. We see a combination of single-family for sale homes and for rent homes. The blue is for sale. The for rent includes apartments. So we are undersupplied. Let me give you sort of a more stark look at this. This is not self-serving data from realtors. This is true. Statistically speaking, a household formation is when children move out of their parents' house. I expect applause when I say children moving out of their parents' house, okay? But when children move out of their parents' house, statistically, that is a household formation. If we go back to the global financial crisis, I'll call it sort of ground zero for the housing market, and if we look at cumulative additions to supply of new single-family and multifamily housing, so that's new apartments and new single-family homes, and we look at cumulative additions to supply compared to cumulative household formations, we see a multi-million household deficit. So we have an undersupply of housing in this country, okay? Demand remains high. I showed you how rents a few slides ago were outpacing, rent growth was outpacing home price appreciation. And still through 2024, we saw demand for apartments, demand for rental housing, even if it was single family rental housing, being strong. So let me just talk about sort of how you as a retail investor can access real estate. The most common way that the average American access real estate for a slice of their investing portfolio is the ownership of their own home. That's the number one way. The number two way is some additional home, which is rental property. It could be a second home that they rent sometimes of the year and they use it as a family, or it could be a second single family home that they rent out. Very common across this country is people living in two-family homes where they live in one and they rent out the other, okay? That's the traditional way in which people have access real estate. But if you don't want to be in the home ownership business and you don't want to be a landlord, which, by the way, anybody here a landlord, it's the worst business in the world, okay? Before cell phones, maybe it wasn't so bad. After cell phones, terrible business. No one's toilet overflows in the middle of the day when you can get a plumber on the phone, okay? It only happens at 2 o'clock in the morning. So what you find is you can either invest in REITs, and I think Ralph showed the chart of real estate sort of potential and the verge of a breakout. Alternatively, you can invest in real estate in the private equity market. The problem is it hasn't been democratized. So real estate as an investable asset class was somewhat democratized, very much democratized through the Real Estate Investment Trust. But if you wanted more entrepreneurial opportunities to invest in real estate, it's not necessarily accessible to the traditional retail investor. So there's boutique firms like ours, Madison Ventures Plus, where we have multiple platforms for retail investors to invest in commercial real estate. We have one called Modern Living, we have another one called Angeli's Madison Residential, and then we have M2 Communities. The first two on the chart are where we're building single family homes to rent. The second one is the manufactured housing business. I say all of this as a commercial. I'll be in Champaign 2 and 3 from 1:30 until 45 minutes later, so it's 2:15, and I'm going to go into all of this in a deeper dive. Let me just give you an example of modern living. That's the kind of homes we build. And what we do is, rather than building homes stick by stick and brick by brick, we build homes in not a prefabricated fashion where we build boxes in a factory, we build panels in a factory. We assemble homes on site as opposed to building them on site, which is considerably more efficient. This is our way of looking at it. If you build homes the traditional way, or you build real estate the traditional way, your timeline for building it is longer. That's the red line on the top, and money pours out as a result. If you do it our way, you do it faster, and there's no money leakage. Examples of the kind of product we build. The left is townhome product. And what we try to do is focus on what I'll refer to as urban or suburban infill. There's a lot of sites that you drive by every day that are vacant, and you scratch your head because people live all around there, and you say, why is that site vacant? Reason number one generally is family members own it and they're fighting with each other over how much to sell it for. Truth, that's generally the reason. But we look at sites like that as opportunities. Just order of magnitude of how we look at these sites. That site you just saw, which is in Sarasota, Florida, not too far from the headquarters of the Money Show, it's a $1.3 million equity investment. We're going to build 14 homes. I'll show you what they look like in a second. And the yield on cost is 8.4%, and the unlevered IRR on that investment over a 2-year hold is about 60%. And the reason why is because most builders who would look at a site like that, most builders see that as their traditional way of building it, brick by brick, stick by stick, 2 years to build it. We can build that in probably 6 or 7 months. We can get it leased up, 14 units, in 6 or 7 months, if not shorter, and we can market and sell the thing at the end of 2 years and get a return like that. That's sort of the way we think about real estate versus the way most people do. We have a glaring shortage, if you go back to the slides I showed you earlier, of attainable workforce housing in America. And our philosophy is to build quickly, high quality, in places where people live, in places where people are moving, and deliver outsized returns to our investors. That's just a picture, it's my last slide, of how efficiently we can put 14 units on a site like the one you just saw. That's what the apartments look like. They're townhomes stacked. And if I was a young family starting out and I wanted to rent something because I didn't have down payment to buy, I'd rather live in a 2-story townhome for rent as opposed to an apartment flat like most people live when they start out raising a family. In any event, that is my last slide. We have time for questions, Mike? Yeah. Questions? Where did I get this jacket? No? Anyway.
2 questions.
Sure.
The real estate market, like the stock market, has sectors.
Yep.
I won't talk as loud.
Yeah.
The real estate market has sectors. What sector would you rank at the top, looking at an investment horizon of 5 years?
If you asked me that question 3 years ago, which you didn't, I would have said warehouse, okay? The least sexy thing in real estate, because we just still hadn't solved the last mile delivery. But over the last 3 years, it's become apparent to me that housing is the single biggest demand-supply imbalance in real estate, okay? I could go through, and I'm happy to do it in my session, come, and you can literally ask me anything. Office sector, retail, they all have their ups and downs, and they all can get trapped in a bad economic cycle. But when you have 7 million homes that we haven't built in this country for households that have been formed, there's tremendous opportunity in there. The problem is you can't do it the way people have been building, because then you can't deliver product at a price that people can afford. But I would say housing writ large, and that includes manufactured housing also known as mobile home parks. Mobile home parks are the gem.
So the follow-up is one of the truths that I know about real estate is that all real estate is local.
Yep.
So what are the top 3 real estate markets for the housing sector?
We're really big on the states that have low barriers to entry and no state income taxes, because those are the places where people are moving. The Carolinas, Florida, Nashville, right where we are right now in Nevada, states with no or very low income taxes are where people are moving because jobs are clearly mobile. Two more?
Okay.
If you don't get a chance to ask a question here.
And I have slides for that session, but if I literally did nothing but answer your questions for 45 minutes, I'd be thrilled. So.
Perfect.
I'm curious where you think, and if you do any investing in qualified opportunity zones and where that's going. And nobody's been able to tell me why they don't allow QOZ funding by other than appreciated securities. Why aren't there funds out there, and why don't they allow just cash investments so they could broaden the investments and ramp it up further?
I spoke to Senator Tim Scott's chief of staff when they were thinking about opportunity zones. And I don't think they listened to me because I told them it was a really bad idea. Real estate is about 2 things. Location, we all know that, right? You've heard that. But the second thing is timing, okay? And the problem with opportunity zones as a structure is they impose a statutory holding period on a piece of real estate in order to take advantage of the favorable tax treatment on the gain. That's not the way real estate works. If I built those homes, the 14 townhomes in Sarasota, and I could sell them for a 60% IRR to investors in 2 years, I'm gonna do it. I'm not gonna hold them for 5 more years just to take advantage of something that's in the tax law. I think my investors would be happy to pay regular capital gains tax or even ordinary income and get their money back. So that's the challenge with opportunity zones. It's anything that's a creature of the brains in Washington, D.C., could be a departure from the market. I like the concept. I think it needs more flexibility, and what you can invest in, you know, how you get money in, is also part of the lack of flexibility. So,
thank you.
You bet. Good question. I think he's last, right? All right.
Yeah. My question is, how are you adapting your business to the increasing insurance costs? I'm from North Carolina, and I just got hit with a 40% increase, and the insurers in our state asked for a 99% increase, okay? And we're in North Carolina, not in Florida. So, you know, how are you factoring that into your business? Because it's going to be such an impact. I don't see this ending.
That question hurts as a Floridian. I feel your pain. I have 2 answers to it. Answer number 1, and I've said this on the air a whole bunch of times on Fox Business. For your home, if you live in North Carolina or Florida, just keep raising your deductible and the insurance company will love you. If you keep the deductible the same, they're going to destroy you with increased premiums. As a business owner and a business runner, doing projects in North Carolina, South Carolina, in Florida, California, where we have a presence. It's been a hard thing. We have historically budgeted insurance expenses at a higher level than the renewals actually came in. We bake into our business planning the fact that insurance is an unpredictable sum, and we've been incredibly conservative in budgeting that, so we haven't been surprised. But I'll tell you, it's a challenge. It is 100% a challenge. And, you know, again, I'll go into it in detail in my breakout, but it's a challenge. But if you don't go into real estate investing and underwrite the cost of insurance in your investment thesis, you could easily underperform returns. Thankfully, we've been ahead of the game and have been conservative. So, in any event, thanks for your time. See you all at 1:30.